Hello and welcome to CoronaNomics, brought to you by Econ Films. This week, coronavirus and the end of cash. The pandemic has accelerated us into a cashless future. The share of payments using cash had been falling long before this crisis, and now many businesses have opted for digital payments only. At least that's the story we often hear. But on some measures, cash, notes and coins, has had a burst of popularity this year. Is the demise of cash exaggerated? But if it is an inexorable trend, what are the implications for monetary policy, for inequality, and even for our freedom? I'm Ben Chu, economics editor of The Independent.
And I'm Lizzy Burden, economics reporter at The Telegraph. We'll be your guides, and if you like what we're doing, please hit the subscribe button as it helps people find us.
Joining us this week is Ken Rogoff, a professor at Harvard University, former chief economist at the International Monetary Fund, and an international grandmaster of chess. His 2016 book, The Curse of Cash, argues that the question of how we pay, whether using standardised coinage or cryptocurrencies, lies at the heart of some of the most fundamental problems in monetary policy and public finance. We're also joined by Sir Howard Davies, chairman of NatWest Group, who was previously director of the London School of Economics, the first chairman of the Financial Services Authority, deputy governor of the Bank of England, and director general of the Confederation of British Industry.
Welcome to you both to CoronaNomics.
Thank you.
We're going to see a chart which shows the amount of notes and coins in circulation by value this year. So even as the use of contactless payments has risen out of necessity and choice by many customers and businesses, so is the amount of notes and coins out there in these economies. Now, some hypothesize that it's the hoarding of notes in these times of insecurity that explains that. Others say it's because businesses haven't been physically able to deposit cash at banks. Professor Rogoff, first of all, what's your interpretation of what's been going on this year with cash?
Oh, I don't think there's any question that it's hoarding. Interest rates have collapsed. They're zero or negative in many places. And I think a lot of the people who are hoarding cash are the same ones who were hoarding it before the pandemic. There's certainly others. The use of cash is in decline. All evidence shows that. We have minimal data on cash usage, occasional central bank surveys. It does show it in very sharp decline, but we have very good data on credit cards, debit cards, and those are clearly soaring relative to income. So there's no question it's being used less. The pandemic has accelerated that, but they're being hoarded a lot.
So Howard, do you share Professor Rogoff's view of that fundamental story here?
Yeah, there are some mysteries, though. The Bank of England recently acknowledged that they, as it were, lost several £1 billion of cash, in the sense that they couldn't really work out where they were. Normally the bank has a fairly decent idea of where cash is in the economy, and there is a bit of a mystery. But and that may be to do with businesses not being able to deposit, although actually most bank branches have been open. But there's certainly been a dislocation between the amount of cash and the usage of cash this year, because the usage of cash has gone down. We do have reasonable data on that. And if you look at the percentage of payments in the whole economy, it was just before the COVID crisis started, it was 24% of payments were made in cash. By May, it had fallen to 12% because of the scale of the lockdown. But interestingly here, when we reversed the lockdown to quite a large degree, which we may be somewhat regretting now, but the economy was allowed to reopen in June, July and August. And in fact, from having been 24 before down to 12 in May, it went back to 19 in August. And probably on our data, although we don't have precisely accurate data for the last 3 months yet, but it looks as if it's gone up again. So I would say that at the moment, it's probable that the proportion of payments in cash has gone back to just below the level it was before the crisis hit, which suggests that it's not been a fundamental change in customer behavior. It's been more the fact that it just wasn't possible to make payments in cash during the lockdown.
Interesting.
Yeah, I would just only add to that if you look at the value of payments, cash is much smaller. I don't know the number in the UK, but I'd guess it's only 4 or 5% and not 24%. In the United States, it's been dropping precipitously. You know, maybe even 10 or 12 years ago, it was 15%, and now it's probably 5 or 6%. So it's used in small payments, but credit cards and debit cards, by many studies, are making a lot of inroads into that. So, I mean, the trend, it's not something happening overnight, but it's been pretty strong for a long time.
There's a danger here that Ken and I end up playing statistical tennis here, but it's still about half of all offline transactions are made in cash. It was 49% before the crisis, went down to 38, is now back up in the mid-40s. But what's kind of peculiar about the difference between the payments data and the cash holdings is, of course, the payments data shows that cash is now used mainly for very large numbers of very small payments. But of course, where the cash holdings are in the large notes, which are not used for any of those payments at all. So there's a dislocation between the two.
So we've touched on monetary policy a couple of times there. I want to focus on it now. The argument for digital currencies and against cash is that they give monetary policy more room for manoeuvre, specifically if a central bank wants negative interest rates. So here's a chart showing the central banks that have put their rates into sub-zero territory. You've got Japan, Switzerland, Denmark, and the ECB currently below the zero line, which is dotted on this chart. But as you can see, the US and the UK aren't quite there yet. Professor Rogoff, if there is a move towards digital currencies, central banks may use negative interest rates even more. So would we have been able to respond to the pandemic more effectively had we already been in a cashless world?
Well, I don't know about respond to the pandemic specifically, because cutting interest rates when people can't go outside to buy anything, doesn't do as much as it might in normal times. But in general, in this low interest rate world, I, for one, think we should be able to use deeply negative interest rates when we need to, which isn't possible if people can hoard cash. There are a lot of ways to deal with that short of going cashless. I don't want to get into it here, basically involving anything from setting up a dual exchange rate system for cash and deposits. I know that sounds head spinning, but not so difficult, to really just regulating how much cash they print. But I believe that would be very helpful. We'll see if in a couple of years interest rates are still at very low values, as my colleagues Lawrence Summers and Jason Furman argue. I think the idea that we don't ever use normal monetary policy again is very wrong-headed. And we will look at these negative rates, which will finally raise inflation to the levels that central banks are targeting. And then interest rates will go up. So I want to emphasize, it would be a temporary thing.
And so, Howard, one of the reasons that we're told central banks shouldn't use negative interest rates is because they make commercial banks less profitable. Does that make them a bad idea overall?
Well, here I am a little bit torn. I mean, I agree with Ken from an economic point of view. His logic is impeccable. Speaking as a commercial banker, I still hope it doesn't happen, because there are some technical issues, first of all, and some contractual issues. I mean, there are many bank systems that actually cannot easily go into reverse and charge a negative rate. There are also, in addition to the cash problem that he talks about, there are some contractual issues. Quite often banks have got contractual arrangements with customers which don't envisage them paying a negative rate, and that's quite a complication. So I think the banks could adjust to dealing with negative rates, and indeed they have done so in parts of the Eurozone, but they do need a bit of notice to do so, because there are certain systems changes that you have to make. in order to get yourself able to deal with negative rates. As for whether it's a useful monetary tool, well, I mean, in theory, it should be. If reducing rates from 1 to a half makes a difference, and it ought to be the same from 0 to minus a half. But I think the problem at the moment is I'm not sure about the messaging that would give. It would seem like a pretty desperate measure at a time when the economy is flat on its back. And whether you get much in the way of enhanced investment and activity as a result of negative interest rates now, I have to say I'm very skeptical about.
On the topic of central banks and their ability to operate in the pandemic, Andy Haldane, the chief economist at the Bank of England, recently said that the sheer size of quantitative easing since the global financial crisis, quote, has contributed to a loss of understanding and perhaps some trust in the role of monetary policy and its degree of separation from government actions. Do you have sympathy with that view, Professor Rogoff?
Well, absolutely. I mean, pure monetary policy is interest rate policy. When central banks are doing these quantitative easing operations, they're really not doing anything that the Treasury couldn't do if it had the competence. When the central bank just prints money, that's the modern monetary theory, it's not really doing anything different than shortening the maturity structure of debt, which the finance ministry or the Treasury could do on its own. When the monetary authority steps in, the central bank steps in and buys junk bonds, which the U.S. has done in little parts, or buy municipal debt. These are fiscal actions. That's fine. We needed fiscal actions. And I think I actually completely agree with what Sir Howard said, that right now, that, we're trying to support psychology. This isn't the time for thinking about this. But we do need not just fiscal policy, but monetary policy. Again, there are people who say, forget monetary policy, just use fiscal policy. I'm sorry, but it's very political. I think it's hard to use in the technocratic way where monetary policies, I think, been quite successful. So I think we need a mix of both.
And so, Howard, what do you think about Andy Haldane's view?
Well, Andy's right that people are a bit confused at the moment because, the government issues debt with one hand and the Bank of England buys most of it back with the other hand. And people find that quite hard to understand. I mean, it isn't inexplicable, but undoubtedly it's tough to understand. And I'm not yet sure that our leading politicians, or indeed even central bankers, have been able quite to articulate this in a way that makes a lot of sense. And the worrying thing I think you then get is that, well, I don't know quite what Ken's view of this is, but it seems to me that there are some truths embedded in modern monetary theory, and there is also some quack medicine in there too. And the danger at the moment is that the quack medicine dominates the useful theory. It is a mixture of monetary and fiscal policy, and it's not particularly well explained at present.
So many people still don't have bank accounts. There are around 1.3 million people in the UK who are adults in the UK who are unbanked, and 7 million unbanked households in the US. And this is one of the objections that people raise to the demise of cash. And the traditional answer, as you will know, is that the government should simply give people bank accounts. But for whatever reason, this hasn't actually happened yet. So, Professor Rogoff, first of all, inequality has risen, it seems, in this crisis. Couldn't going cashless potentially be a social disaster if we don't get the transition right, exacerbating recent problems? Is there a danger, do you think, of going too fast?
Well, of course. I mean, I don't think we want to go cashless. The questions are these people on very low income, the ones holding the $100 bills at more than $5,000 for every man, woman, and child in the United States? I don't think so. I think if we retain the smaller bills for a long time to come, it will have very little impact on them. It will have an impact on people avoiding taxes, crime, etc. Yes, we should have better financial inclusion. Many countries manage to do that. It's not just the Nordic countries. A country like Japan basically has 99.5% financial inclusion just through its bank regulation. It's not very expensive to provide. I think absolutely we should do this. India manages to do it. So certainly countries like the United States and Great Britain can. I don't believe providing basic debit accounts would be that expensive. And many of the people are ones that get transfers, and the government could save money making these transfers if they had a way to do it electronically. This is something that needs to be done whatever we do with cash.
Yeah. Let me come to you. So Howard, on the subject of financial inclusion, could you give us some insight into what the NatWest Group is doing to help the unbanked to get accounts? And is this something that commercial banks should be driving, or should it be driven by governments?
Well, commercial banks can do something in this area, and we do have a basic bank account, which is extremely well. It's free to operate, actually, but it's not been massively successful. And I think nor has the same products offered by the other clearing banks. I mean, I think you do need a range of measures here. I'm quite enthusiastic, for example, about local credit unions, which I think can be a very good initiative. Actually, they have more of those in the US than we have here. But in Ireland, for example, they are quite a big part of the solution at the bottom end. The Swedes have gone in for giving tax incentives for people to pay through banks, which has encouraged some low-income Swedes to get into the banking system who weren't there before. So I think there are ways in which you can do this, and I mean, I think it would be needed and will be needed more as cash usage declines. I think it's 2.2 million people who only use cash, and so we do need to think about what the implications on those people are if you've got increasing numbers of outlets that won't accept cash. Now, of course, in the US, there's been some legislation in certain places, like in New York, to require retail outlets to accept cash. We don't have that. And increasingly now you're getting retail outlets not accepting cash at all, which is a problem for people at the bottom end. There's also, of course, the issue of beggars, which is not a trivial question in a city like London, because apparently 30% of people use cash for their weekly grocery shop, but 94% use cash if they're giving to a homeless person. So how do we deal with all of this complex of issues? I think is quite complicated. And I don't think there is one single solution like a cheap bank account, which is going to deal with all of these problems of the decline of cash.
Now, looking towards the future, the value of Bitcoin and Ethereum have risen this year, as you can see in this chart. And Professor Rogoff, if central banks introduce digital currencies and everything is digital, aren't we going to see more appeal of these private digital currencies like Facebook's Libra, which could launch as early as January? And wouldn't that give power to business leaders like Mark Zuckerberg when a currency is one of the powers of a sovereign state?
I don't know what form Libra is going to take, by the way. It strikes me that it's more a competitor to credit cards and PayPal than it is to digital currencies, because they're going to report your identity. The government will be able to know who you are. And with some of the cryptocurrencies, that's possible, but very, very difficult. I tend to think that these crypto assets will not be at the center of the financial system ever. They exist now really because regulation hasn't come into place fully. I think as it does, they will continue to be marginalized. I don't think they'll be worthless, because we have, states like Venezuela, places that are just dysfunctional, and there is a use for that there. But I think in countries from the US to China to Europe, they're not going to want to have payments made that cannot, in principle, be tracked. They have to collect taxes. They have to, enforce regulation. You could talk about terrorism, but that's melodramatic. It's really much more mundane. The government has to have some capacity to trace information. And yes, there's a balance between privacy and the government's power. But these cryptocurrencies, if they became too big and too important, I think would create a huge distortion.
And so, Howard, wouldn't there be problems of financial instability if you have all these digital currencies?
You started with a chart of showing Bitcoin and Ethereum. I don't think that they are part of the solution at all here. I mean, their volatility is such that they are not a stable store of value, and they are extremely expensive to create. Environmentally, they're very damaging to create, and they are barely used in transactions. They just don't really tick many of the boxes under the heading of money. A stable coin, which is Facebook's Libra, undoubtedly, potentially, could perform more of the functions of money. And the initial formulation of Libra by Facebook really put the frighteners on the central banks, because they could suddenly see that if they did get this going and it did manage to monopolize international transfers, which was the bit that they were focusing on, because international transfers are actually quite expensive and arguably they're too expensive, that Libra really frightened the central banks, because that was going to be backed by assets. It wasn't going to be volatile like a Bitcoin. Indeed, the latest formulation of Libra has it just backed 1-to-1 by the dollar, as I understand it. I think it is quite likely that some of the central banks will issue digital currency. Indeed, arguably the Chinese already have, but on an experimental basis. And the Swedish central bank governor said to me recently that actually there was nothing revolutionary about the central bank currency. Sweden has, of course, gone further on the decline of cash than almost any other country. And he said to me, look, since 1668, when the Riksbank was founded, the Swedish citizens have always had the ability to have a claim on the Swedish central bank, and usually, of course, up to now in the form of a note. And if the notes all disappear, how are they going to have a claim on the Swedish central bank? So this would be taking something away, and we will replace that with a central bank digital currency, which is not a new thing. It's just an old thing that they've always had. You've always been able to have a claim on the central bank. I think it's quite likely that that will happen, and that will significantly reduce the attraction of things like Libra. The big question, though, I think, is whether in going down the digital currency routes, the central banks will do that themselves with everybody, with Ken having his account at the Federal Reserve. Whether it would be in Washington or Boston, that's a different kind of subtle question. And I would have an account at the Bank of England, which actually I used to have when I was deputy governor. Or will these central bank digital currencies operate only through the commercial banks? So that if you go along to NatWest, you could say, well, would you like a NatWest deposit account on which you'll get, in the normal way, you'd get some interest? Or would you like a Bank of England deposit account, managed by us, on which you won't get any interest, but of course it'll be completely and utterly safe and accessible and hard cash and at any point? And that is another way of going about it. I think that's the big decision that central banks have got to make in this area. Bitcoin kind of nothing to do with it. It's whether they really want to have a direct relationship with individual citizens and allow them a digital claim on the central bank.
I think the Bank of China has very clearly chosen the second way that Sir Howard described. They explicitly said, we're trying to have an evolutionary change where you still have your bank account, but when you go to the bank and you take out cash, it's actually an electronic claim on the central bank, which you can use with other people. It's an experimental phase. By the way, the United States, we don't have a digital central bank currency, but if you want to hold assets at the Treasury, the U.S. Treasury, from $100 to $20 million and trade them with other people, that's been there for 10 years, U.S. Treasury direct. And I think the only reason it's not bigger, I think it just has a few $1 billion at the moment, is they don't advertise it and nobody knows about it. Because if they did, I think a lot of money would already shift from bank accounts.
So Howard, picking up on something that you just said there, what work has the NatWest Group done into facilitating digital currencies?
Well, we've thought about it. But I don't think that we've done any work on facilitating digital currencies because we really need to know what it is we'd be working with in terms of the central bank behavior. The methodology I've described as having that option with the central bank. We could do that. It would take a bit of time to get it straightened out, and the bank would, of course, have to provide the facility to have a lot of individual accounts at the central bank if it wanted to go in that direction. We're not ready for it, but I don't think in principle it's complicated for us to do.
And Professor Rogoff, you mentioned privacy earlier. We're told that reducing reliance on cash could have benefits for reducing crime, like money laundering and drug smuggling. But what are the consequences of the rise of digital currencies in an authoritarian state like China? Isn't the anonymity of cash something that has a social value in underpinning citizens' privacy and rights?
Well, I mean, absolutely. There's a question of how to balance your right to privacy and the government's right to, say, collect taxes on the transactions you make if you're getting paid. That's, by the way, part of why some people only use cash and some businesses only take cash. There's a massive amount of tax avoidance. What's the balance? And my quick take is you want to get the big players for the moment and not so much the little players. There are technological ways to provide a limited privacy for a limited amount of funds. The European Central Bank's been studying this exactly. At the end of the day, I think we need to regulate cash better. The privacy issue is important. I don't know in China anybody has any privacy with cash or not if you follow their facial recognitions and everything that they're doing.
Right. Well, it's been an extraordinarily wide-ranging conversation about COVID and the future of cash, and it's been a great conversation. So thank you so much to Ken Rogoff and to Howard Davies for appearing on this episode of CoronaNomics.
Thank you, Howard.
Thank you. Thanks,
Thank
Ken.
you both. This is my last episode of CoronaNomics, but it's been an absolute pleasure being part of the series, and stay tuned for more from the team in the future.
And remember, if you like what we're doing, please hit like and subscribe.
And if you'd like to talk to us, just leave us a comment below.
This has been CoronaNomics, brought to you by Econ Films.